It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. And here are the top stories. Is the Fed any closer to a rate cut? Well, investors look ahead to the U.S. inflation data on Tuesday for more clues on where rates may be headed. Chinese lawmakers set to wrap up their annual meeting. We discuss whether investors heard anything that could change their mind on equities. Also ahead, it's not just AI mania. The short volatility trade is roaring back on Wall Street, with investors sinking billions into ETFs, betting on a calm market. Plus, we have a great lineup of guests to discuss markets. AVM Capital founder and CIO Ashwin Murthy is up first, and later on India Focus, we have Anand Rathi to weigh in on the rally there. Well, in the markets, it is a big week ahead. Of course, we have front and center that CPI data out of the U.S. that is front and center in terms of investors. Asian markets under pressure, led by tech slumping about 4%. In chip makers in particular, we saw that pullback in the U.S. NVIDIA leading that pack lower, among Mag 7 losing about 6%. On the back of that, investors looking ahead to U.S. CPI data, as we said, looking for guidance from the Fed, perhaps. This is a Powell who has said that we're not too far from the first cut. He just needs a little more evidence. CPI getting to 2%. Taking a look where we are in terms of the benchmarks right now, Nikkei 225 down 2.5%. It is really about the yen story inching higher, and that is dismantling the rally that we've seen so far. Pharma versus USD extending the 2% rally, which we saw last week. JGB yields also trending up after a report saying BOJ considering scrapping that YCC. In terms of the other markets, we have losses for the Philippines as well as New Zealand. China in focus. NPC front and center as well. Concluding this week, onshore, offshore stocks have moved pretty much in opposite direction. Take a look where we are in terms of the Chinese yuan. Pretty flat right now. It's been stabilized by that fixing by the PBOC. MSCI Asia Pac Index now extending its loss to more than 1%. As we said, a big week ahead. We'll get the latest inflation print out of the U.S. on Tuesday. That likely abated gradually last month while retail sales rebounded, illustrating why the Fed is in no rush to lower interest rates. While Bloomberg Economics expect China's PBOC could lower its one-year medium-term lending facility by 10 basis points, marking the first cut since August. And India's CPI may continue to ease in February, which could force the RBI to rethink perhaps its hawkish bias. And here's a breakdown of consensus expectations for the February U.S. inflation reading. Headline CPI forecast to stay unchanged at 3.1% year on year, but core inflation expected to ease to 3.7% year on year. Let's assess how significant the data is. Ashwin Murthy is founder and CIO of AVM Capital, a macro hedge fund manager. Well, likely to stand pat in March, but it is also about the trajectory that the Fed may provide, perhaps.
Yeah, I think the Fed is, communicated to us that they would like to cut interest rates very soon because they think current policy rates are quite restrictive. I personally don't understand why they think it's restrictive, because if you look at the stock market, you look at growth, things are doing quite well. But, they're using a textbook definition of what is restrictive, and they feel that interest rates are quite high. So I think if inflation does mean revert lower tomorrow, and we see that continue in April, May, they're going to cut in June.
It is about the dot plot, and it doesn't take much to move expectations, because all it takes are two Fed officials to perhaps make some changes for the median to move. What are you looking at?
Yeah, so I think if inflation comes in at 0.3, there is a chance that 2 dots might move. So all you need is 2 governors to change their dot, and we could get 2 dots for this year. But if it comes in, slightly lower than that, I think, Powell's going to do what he needs to do to keep those dots at 3, because he does want, he's communicating to us that he wants to start a rate cut cycle. I'm not sure what's behind that, but when we look at the data, it doesn't look as weak as what he's seeing. This textbook definition of real rates is probably wrong right now. With markets soaring and financial conditions so easy, it's clear that the markets aren't very tight.
And we have El Arian weighing in saying that, you know what, jobs in particular is pretty ambiguous. Let's take a listen to what he had to say.
I'm honestly paralyzed. I wouldn't know what to point to. This is an ambiguous report. And once in a while, we get ambiguous reports. We continue to produce jobs. We continue to contain monthly hourly earnings. The U.S. is just exceptional, but markets have priced in expectations. And that's why I see this ambiguous as opposed to simply positive.
So it's not clear cut.
No, I don't think so. But I think the jobs market, people take away what they need to take away from that payrolls report, but it still looks robust. It's not overheating. We're not getting 350K jobs, but it's still a very solid labor market. Wage growth is healthy. Household balance sheets are healthy. It's a strong economy at the moment. We'll have to wait for that data to turn, but I think the Fed just wants to go ahead.
And the feeling in the market is that if that disinflationary trend were to continue, we could see an everything rally.
Yes, so the markets are sort of front-run that everything rally right now. So we're seeing that.
So a lot has been priced in.
A lot has been priced in. The market is still pricing in more cuts than the dots. We're between 3.5 and 4 right now. We could see that disinflationary process speed up over the next few months. One thing we haven't seen is shelter inflation coming off. If that starts to come off, like many leading indicators are pointing to, we might get that false impression that inflation is coming off very quickly. But that's only going to last for a short bit. And then the disinflationary process from goods is about to end. Once that starts going up and services inflation stays sticky, we might have come into a surprise towards the end of the year.
What might catch the markets by surprise, maybe in the shorter term? It's priced pretty much for perfection right now.
I think services inflation remaining sticky or inflecting higher will cause a lot of pain in the market because that would not allow the Fed to cut rates, right? Because that's the part that is linked to wage growth, is linked to the labor market. And they're going to then keep rates restrictive so that the labor market softens and services inflation comes down. The markets are not prepared for that.
How prepared is the market in Japan for a higher and stronger yen? Today, we're already seeing a massive tilt to the bottom. Currently, Nikkei 225 down about 2.5%. It does look like that weaker, stronger currency is weighing on sentiment.
Yes, I think in Japan, the weak yen has helped a lot, both the economy and the stock market. And I don't think the economy is ready for a very strong yen. If the yen appreciates slowly, I think it's okay. But if we drop to like 130 on dollar yen, I think that would cause some problems and the Nikkei would tumble.
But how much upside is there for the yen?
I think it depends on the pace at which the BOJ tightens policy. So for us, whether they do it in March or April is irrelevant. It's what matters more is the path beyond that. I think they're going to have a dovish exit from, YCC, negative interest rates, and I think they'll take their time. We need to see how the wage inflation, these wage hikes start to filter into the economy. I don't think they're going to jump the gun.
The question really is how much more foreign money is expected to pour into Japan? Because if you take a look at where yields are right now, the returns from investments in Japan, there's also a limit to how far they can go.
Yes, so if the yen continues to weaken, then you might see the Nikkei continue to power ahead.
Fundamentals enough to support the rally that we're seeing in Japan? Dividend yields looking pretty good for Japanese companies, for instance.
And buybacks. So, these two forces are helping the market along. So I think, you got zero rates, and then between the dividend yields and the buybacks, that's about 5% yield on a zero rate economy. So that's pretty strong.
So what would you be buying in Japan?
I think for us right now, we're going to wait for this BOJ to end. And I think we'd be actually looking to go long dollar yen again, because we think a lot of this move in the currency is linked to the interest rate differential. And looking at how BOJ likes to drag its feet, we expect real rates to stay largely negative in Japan for a long time.
Still not convinced yet, considering that you're still waiting before pumping in more money.
Yes, so I think, markets are going to react to this exit, which is only a 10 bip hike. Maybe you get dollar yen into the low 140s, and I think it'll be a great buy there.
Okay, Ajvin, stand pat. Ajvin Murthy, AVM Capital, is sticking around. Still to come, Anand Rathi, Private Wealth Management, tells us why they're staying cautiously optimistic on the Indian markets. More on their outlook later this hour. Keep it here with us. This is Bloomberg.
our view is that one should not invest in China.
I don't think it's uninvestable per se.
High dividend and clients asking for income definitely will still continue to play.
You got to be very, very careful if you're investing in China right now.
We think the economy is going to steadily continue to slow down for the next 10 years.
I think the biggest risk here is policy maker complacency.
It is not clear what the overall general direction of policy will be long term.
Stimulus is important, but I think China has passed the stage where they want to throw a lot of money, build a lot of leverage.
We're in a new paradigm. The leadership's economic priorities are completely different.
It's very difficult to restore the market confidence.
The sentiment is really bad. I talked to my friends in China, and they're talking about that there is no hope.
I think it's going to be a harder challenge to bring the foreign investors back to China.
And those were some of our guests speaking about their investment outlook for China. And markets have been a mixed bag over the past week with the NPC underway. The CSI 300 posted a slight gain while the Hang Seng fell. Across sectors, raw materials showed the most strength, while real estate and consumer discretionary pretty much lagged behind. Now, China's annual session of parliament is wrapping up in a few hours with perhaps more emphasis on what leaders did not do than what they did. For more, let's bring in our China economy and government reporter, Lucille Liu in Beijing. Lucille, the key takeaways here.
Yeah, I mean, it's been one of not a lot of surprises, I must say. A lot of the targets for the year in line with economists' expectations. Of course, we did have the premier presser being canceled, so that was a big event to conclude the two sessions that we always look forward to, and a rare meeting for foreign journalists and the premier of China. So that's no longer in the books. Today we're basically looking for the passing of the State Council's organic law that essentially is a codifying of something that's already in place, which is that the government is really serving the party, and in this case also sees vision for the economy.
Lucille, of course, front and center, that GDP target of about 5%. Are we any clearer to how China would get there?
Yeah, I mean, we did see some good, CPI numbers recently. Of course, economists are saying that's not going to last. That came off of basically the Lunar New Year holidays, increased spending there. But actually interesting there, we also had, it was increased trips, but per capita spending decreased about 10% from pre-pandemic. So people are being more frugal, even though, more people are going on trips. So it's, there is a mixed bag, but we aren't seeing anything, anything concrete for how we're going to achieve this very aggressive 5% with not a lot of change in policy. Of course, that work report again emphasizing these sort of new productive forces, its focus on manufacturing. So China very much staying the course there, even though a lot of foreign countries are concerned about overcapacity and what happens if China continues on this track.
That's right. A lot of people saying that to get to 5%, you need a lot more stimulus. Of course, we had data out of China over the weekend as well, that CPI print, it is in the positive for the first time in quite a while. But some say, you know what, it is not sustainable. It is mainly because of the Lunar New Year holiday.
Yeah, absolutely. I mean, deflation, of course, something we're watching very carefully this year. And we did get that bump last month. But, in addition to Lunar New Year, there was also sort of this extreme weather in mid-February. There was, sort of freezing rain here in the north. So that also pushed up consumer prices. So economists pretty much, across the board, not expecting that to continue. And, those deflation worries still very much here. And, that's going to be a major drag on the economy.
Lucille, thank you so much for the coverage there. Our China economy and government reporter, Lucille Liu in Beijing. Let's get insights on markets, the impact possibly. Ashvin Murthy, founder and CIO of AVM Capital. He is still with us. It is a big nothing burger for investors.
Yeah, I think people were expecting something bigger going into the meeting. It didn't pan out. One of the things that struck me was, if you look at some of the targets they've set, we had nominal growth at about 3.5% last year. Now they're expecting real GDP growth at 5% and inflation at 3%. That's a nominal growth of 8%. what is going to get us from 3.5% to 8%? I don't think they're very clear about that, and that's why markets are just not enthusiastic about this.
But this is a different China. China has said the three new, growth drivers would be EVs, would be solar power, batteries, and so on and so forth. That takes time. Why won't you buy into these sectors, for instance, in view of the longer term, perhaps, goals?
Yeah, so I think as a stock picker, there are going to be certain industries that are getting support from the government. Those things can thrive. But a broad market, I think the only way it's going to go up now is to really get investor sentiment back. The wealth effect right now is quite tough in China, both property market and the stock market down. So you're having consumption which is weak, people not willing to invest, and there are not many options. That's probably one of the reasons why they've kept interest rates at 2%, is not at 0 despite deflation.
We talked about how it's a nothing burger, but we did hear from the PBOC saying that it is willing to cut rates further. I mean, realistically, how deep could the PBOC go?
I think they've realized that cutting rates is not going to help too much. There's already a lot of liquidity in the market. They just don't want to increase this leverage problem. The other issue is that given there's no place to invest, nothing much to invest in China right now, if they reduce rates from 2% to 1 or 0.5%, that makes people even more unhappy because there's less to invest in. And the other problem is the currency. If the interest rate differential in the US starts to widen again, that's going to put pressure on the currency, and they're trying to keep it stable.
So how much of a cut could we see in RRR?
You could continue with RRR, maybe 1 or 2 cuts this year, maybe another 10 bips on the policy rate. But all of those are going to have very minimal impact, I feel, on the economy. What really needs to happen is they need to get investor sentiment up. And this program of buying these ETFs is helping. That has put a bottom in the market. If they continue buying these Chinese ETFs every day for the next year, throughout the course of the year, you should see markets start to rebound.
And we have breaking news, or rather headlines from Reuters saying that Chinese regulators are asking banks to step up support for Vanke. I mean, we've seen this before, how the national team comes in to provide the support. Is that enough to revive sentiment?
I think this is important. They can't let a state-owned enterprise, SOE-linked developer go down. It's different from China Evergrande or Country Garden. So I think they will step up support. There are various ways of doing that. They could swap the debt for loans via these policy banks. And I think that we'll see more of that if any of these developers get into trouble.
But have you seen the worst, do you think?
I think we're nowhere close to I think they're trying to plug the gaps on the downside, but what's happening now is they need all these projects to be completed, right? Because a lot of people have bought these properties, we need that to be completed. But after that, where are we going to get the activity from? It's not going to be like the pre-COVID times when, there's a lot of demand for private properties. So I think that's probably you're going to see activity go down a fair bit.
We have heard from China over the course of the NPC that they are willing to intervene, they're willing to step in to ensure that there is unnecessary extreme panic in the market. Is that good enough for you to allay concerns about how bad it could look in China?
I think for now it does allay some concerns because, you have the backstop of the government. But it depends, they need to make sure that they prevent it from getting a lot worse. They need to step in quickly. And it seems like that's what they're trying to do right now. So while they're doing that, they need to get investors willing to buy debt, to offer loans, to buy equities. And that's why they've stepped into the equity markets. And now they put a bottom in that, and now it's slowly going up. It takes a while. I don't think it's something they're going to fix overnight. It might take 2-3 years, but it's just going to take some time.
You talked about the yuan earlier. It has been supported very well by the fixings that we've seen so far. What is fair value of the currency?
Wow, that's a tough question. I mean, if they remove the bans, I think most people think the dollar, it would be trading at 9 or 10 because there's so much money that wants to leave China at the moment because of a lack of investment opportunities. It's something that can't be fixed immediately, but I think they're going to manage. It's in their interest to have a weaker currency because that helps with their exports, that will help with growth. But given where investor sentiment is currently domestically, they can't afford the yuan from weakening too quickly. What would make them happy is that we get a sell-off in the US dollar, a bear market in the US dollar, then they can let it depreciate against its trading basket.
But realistically, can you expect the sell-off in the US dollar when the Fed is now expected to cut rates by 3 times instead of 7 that was initially expected at the end of last year even?
Yeah, we're not expecting that. It's not our base case. Unless you get a hard landing, we're not expecting a very, a long-term sell-off in the US dollar. Right now, most of the central banks, if you look at the ECB, BOE, and the Fed, they seem to be coordinating quite well. It looks like June might be the first rate cut. That just reduces FX vol. So I don't expect a sell-off in the US dollar. I don't expect it to rally very hard. But, going forward, if you get US exceptionalism going to the end of this year, next year, the US dollar should start to rally again.
So yuan by the end of 2024 would be?
It really depends on how much,
If you had to put a figure to it?
Right here.
Right here?
Yeah.
So it's going nowhere?
They're going to keep intervening as long as they have the current account balance to support the currency.
And quickly, has it been surprising that the Asian markets have been pretty much decoupled from China, or have we been seeing that trend for a while now?
We have been, because I think the correlation between the Chinese markets and the rest of the global markets have been quite low. It's been very specific. Tailored. It looks at what's happening domestically in terms of policy. Unfortunately, it's been on a downtrend for 3 years while the rest of the markets have been going up. I expect that decoupling to continue.
Just one final question before we let you go. Of course, it's tech. It is AI. We've seen how AI and tech stocks have rallied in the U.S., but not the same story for Chinese AI and tech stocks. At what point would they be a buy?
I think it depends on the policy in China. They went after the big tech companies, the monopolies. That's not very pro-stock market, pro-equities. If they change their tack, they start supporting these companies, I think it could start to become a buy.
All right, but not anytime soon. Ashwin, thank you. Ashwin Murthy, founder and CIO of AVM Capital. Plenty more ahead. Keep it here with us. This is Bloomberg.
The one place where we could see a correction, and it's just a correction, we're not calling it the end of this at all, is in the chip space. There was probably a lot of double and triple ordering as the word shortage was making the rounds, and that those inventories will have to be digested.
ARK Investments CEO Cathy Wood on a possible correction for chip stocks, and we're seeing some correction here in Asia on the back of what we saw in terms of tech stocks in the US. That slump of 4% for tech stocks. Nvidia led the charge lower, slumping as much as 6%, and at one point erased about $140 billion in market value. Of course, this is one stock, Nvidia we're talking about, that's rallied hard, 70% in 2024 alone. So not surprising that investors are perhaps taking some money off the table. In the meantime, Asian tech stocks falling. U.S. stock lower. Samsung Electronics down by 0.7%. SK Hynix lower by more than 3%. TSMC not spared either. SMIC, though, bucking the trend, higher by about 1% right now. Of course, investors now looking ahead to that CPI print to see what will happen next. TSMC re-entering the global top 10 club after touching that record level. Currently, though, down about 2%. Let's do a check on cryptocurrencies in particular as well. The largest cryptocurrency jumping to another all-time high of more than $70,000. That happened on Friday, giving up some of those gains somewhat today, down about 1.2%. And Bitcoin has capped a 7-week run of more than 70%. Wow, what a run for that cryptocurrency. Ether, Binance.com, Solana in negative territory right now. Now, here are some of the top corporate stories we are following. Bloomberg has learned that Reddit and its investors are looking to raise as much as $748 million in an initial public offering. Sources say the social media platform plans to sell shares in a range of $31 to $34 each, seeking a valuation of as much as $6.5 billion. Reddit has been working towards a listing since its initial filing in 2021. Saudi Aramco raising its dividend despite lower profits to help the government plug its budget deficit. More when we come back. This is Bloomberg. Welcome back. China markets just heading to lunch, and what a lift. CSI 300 index up by 0.8%. Not much to do with MPC, perhaps more to do with China Ivanka rising after depositing about $650 million to fully repay its notes. Hong Kong developers also rising after the weekend home transactions hitting a 3-year high. And of course, we had that report from Reuters earlier on talking about how China is looking for support for for Vanka as well. CSI 300 index up 0.8%. We're looking at the yuan trading at 719.08, pretty much flat versus the USD, a currency that's been well supported by China's fixes. As China goes to lunch, Japan comes back from lunch break, and it is a different story for the Nikkei 225 as well as the topics. It is in negative territory, extending the loss to about 2.5% right now. It has to do with the yen firmer versus the USD extending that 2% rally, which we saw last week. JGB yields also trending higher after a report saying that the BOJ is considering scrapping YCC. Yen at 146.97 versus the USD, extending the strength that we've seen in the past week. Now, to today's big take, and one of the biggest bets on Wall Street right now that's not tied to the AI boom. We're talking about the short volatility trade, once a key factor in market sell-offs in 2018. The bets on markets are back in a new form and on a much grander scale. To break this down, let's bring in analyst strategist Mark Cranfield. Mark, it's just a different name right now.
Well, it's not quite right to say it's not related to AI, because in a way that is in the background actually. Typically big selling of volatility tends to coincide with where markets have a relatively clear direction. So what happens is that investors get confident that the trend, whatever it is, whether it's up or down, but particularly during bullish markets, they get confident that the trend is going to extend, and that means that what they're willing to do is to enhance their returns. They're willing to sell options to other people, whether it's through ETFs or whether it's just over the counter, and because they think that there's a predictable path here, so that means that we'll have plenty of time to get out. If the options go wrong, plenty of time for us to cover those exposures, and especially they will sell the downside put options. They'll be thinking, oh, the market's got this trend is so good, it's going to be such a long time before it reverses. We're not at much risk on the downside. Now, in the very short term, one of the things that could derail this very badly is Nvidia. Nvidia has become the largest retail stock in the market. That means that more people, it's overtaken from Tesla. More retail punters in the US are using Nvidia than any other. And we all know what happens when they suddenly lose faith in a particular stock like that. It could be very unpleasant.
But the thing is, how real is this risk? Especially when you consider that it is a different backdrop now. You take a look at the S&P, it's doubled over the last 6 years. So is it really warranting that, caution?
The big problem that happens with these kind of things is that an event comes along from left field that people just weren't prepared for. That's typically what derails these plays. So, for example, we've got the Bank of Japan coming up. The calls for the Bank of Japan to tighten policy are becoming louder and louder. There's a wide assumption in the marketplace that the Bank of Japan is not really going to hurt global financial markets, because the move is going to be fairly small. People have seen it coming for a long time, until they didn't. So we've seen it before, that even though a change in policy, and don't forget, the Bank of Japan is the only major central bank considering tightening policy. Other people have done it already, and we're thinking about rate cuts in other places. So the people are comfortable with the idea, oh, the Bank of Japan is a small rate change, it won't have a major impact. Maybe it will. Maybe the market is not as prepared for the Bank of Japan as we're assuming, and that can start a spiral of events. Starts hitting with Japanese equities already a bit soft already in anticipation of this. That could spiral into European, into American markets. Suddenly, before you know it, you've got a bit of an avalanche starting, and it all looks very different.
The thing is, truth be told, it is a higher bar for contagion, right? But if you were to look into the crystal ball, might this happen in the next, 6 months, 12 months? Are we looking at 24 months?
No, I think if it's going to happen, it's going to happen within 6 months. This is the way it's building up. For it to have an impact, for it to really hurt people, it has to happen within a few months. If it happens in 12 months' time, by then a lot of these option positions will have expired anyway. So it has to happen while there's a large amount of them outstanding, which is now. And they probably will be rolled over in the short term. So if it's going to happen, it's a near-term event. It's not something for next year.
If there's one telltale sign, what would that be?
It will be something like where, for no particular reason, you see a major sell-off, particularly in the US markets, for example. So we have a week where, this week we've got CPI data in the US, so it probably won't be that. It'll be a week when there's not much data, maybe no Fed speakers, everything looks calm on the surface, and the market ends badly that week. And Why did it? There's no particular reason. And that's the start of people unwinding positions, and it snowballs.
Beware. MLife strategist Mark Cranfield there with his take. And of course, Bloomberg Tamil subscribers can see more on this at NI Big Take Go, along with more deep dives into the biggest global stories. Well, still to come, Anand Rathi Private Wealth Management tells us why they expect India's equity market to grow even further. More on the insights next. Keep it here with us. This is Bloomberg. Well, let's talk India. Markets has been going gangbusters, and we know that international investors has been piling into small and mid-cap size stocks to get value now that the big names have been taken up, and of course they've been outperforming those small and medium-sized companies. Let's talk all things India with Shweta Rajani, who oversees more than $1.5 billion as head of mutual funds at Anand Rathi Private Wealth Management. Good to have you with us. How much more upside? I mean, people are talking about overstretched valuations. Can India continue its rally?
Hi, good morning. Definitely, I think the rally can continue from here on. And in fact, in the next financial year, which will start April, if you see the earnings growth coming in, and I'm just referring to Nifty 50, if the earnings growth come in lines of 12 to 13% from here on, and looking at the macro stability, further upside very much possible. Of course, there could be those periods of 5-7% correction, which is very normal. But through the course of the year, a further upside, yes, given positive macros, as well as corporate earnings coming in, valuations being reasonable.
You talk about corporate earnings. We know that in last quarter, corporate earnings rose about 30%. I'm just wondering, for the quarters ahead, how much clarity do you have?
Yes, so the quarter that just went by, if I break it up, large caps saw 20% plus growth, and mid caps we've seen up to 30% growth for a lot of companies coming in. So if I'm looking at the next few quarters, the profit growth for Nifty 50, our estimate is you could see another 13-14% growth coming in here. For the mid cap companies, we could possibly see 15-16%. And for the small cap companies, a 20% plus profit growth looks very much a possibility.
Shweta, where are the big values to be had in China, in India? Some say that small and mid caps are the way to go right now.
Absolutely. So if you see in the last few months, large caps have grown up by around 25%. Mid and small caps have delivered 50% plus. So the perception is it's very frothy in the mid and small cap segment. But in fact, the way I look at it, in pockets, there's still a lot of steam left in mid and small. In fact, our internal numbers say that valuations are pretty reasonable for a large number of small cap segment. So there is further steam left. And, if I just have to put a number, I would say clients can still look at having around 40% odd as mid and small in their portfolio.
Which sectors in particular then?
If I have to give you a name of few sectors, then I would say within the banking, you leave aside the banks, but the non-banking segment in the financial space still is, looking attractive. Pharma, IT, auto, as well as I think, if somebody's looking at long term, then green energy could be a few sectors.
Shweta, is there a risk of hot money? We talk about how, the tide is lifting all boats. When the tide subsides, you'll see who's been swimming naked. I mean, is there a risk that we could see too much hot money in India?
So, there are two portions to it. You have FII and then you have DII. If I look at the foreign institutional holding, the long-term average has been around 21.5%. And right now, FII is slightly below that. So it's at around 20.5% ownership. So which is where, while you'll always have that little segment of hot money, but if I'm looking at the long-term trend, there is a possibility that the FII inflows go back to their long-term averages, and therefore majority of their money would be long-term. Even when I'm looking at the domestic inflows, there's this data that comes from RBI, it's the household savings data, which shows that compared to 10 years back, there's been an increasing change in the asset allocation of a normal Indian household. So if earlier you had around 1% of your annual savings going into equity, today it's around 6-7%. So this is again sticky money coming in. Plus, what is happening is if you see the investments from not the top 30 cities, but your tier 2 cities has started to flow into equity. So they've started to experience it. So I think a lot of the money that's coming in is more long-term sticky.
We know that the RBI has been concerned about euphoria in some pockets of the equity market, and recently it's also clamped down on shadow banking. How are you assessing that risk?
Yes, so actually, if you see in the last few years, RBI has been very clear that they want to have clean balance sheets even for banks. So a lot of the measures that they are taking right now, I mean, we're seeing the retail credit growth picking up. A lot of it is unsecured. So the measures that RBI is announcing, I would look at it more as preventive measures because, you don't want to have a disaster sometime later. So I think this is a good sign, and one should look at it positively. And, over the last few years, we've seen how regulators, behaving and trying to tell the banks that, listen, credit growth is good, but you need to be cautious. So I think I look at it positively.
Shweta, just one final question before I let you go. How are you advising your clients? How should their portfolio look like?
Yes, so I think, few advice to our clients has been look at it from a long-term perspective. Have your strategic allocation in place. You can have that, 5-10% of tactical calls that you take. But if you've decided you want to have that 60-70% equity, then continue with that. Don't be bothered about market timing, market levels. As long as you're looking at 5-7 years from here on, that's your investment horizon. I think equities can deliver 12-13%. So that's, primarily our recommendation. Just stick to your strategic asset allocations and don't be bothered about minor corrections that one may see in equity.
Stand pat. Shweta, thank you. Shweta Rajani, Anand Rathi, Private Wealth Management. Now, staying with India, the nation has signed a free trade pact with 4 European countries that the Modi government says will create 1 million jobs in 15 years. The deal with non-EU countries, including Switzerland and Norway, has been 16 years in the making. India gets private sector investment commitments in return for the Europeans securing easier access to Indian markets as well as products. Now, here's how shares of ABB, Nestle, Novartis listed in India are doing pre-market, all in positive territory. Nestle, India, though, unchanged at 25.60.95. And India expected to announce election date soon, but the constitutional body that oversees voting has just lost another member, with only its chief now remaining. For more, let's bring in our South Asia government reporter, Swati Gupta in New Delhi. Swati, what does it mean for the upcoming election?
Yeah, so the Election Commission is a 3-panel body, and one member retired last month, and another member resigned over the weekend. And the Indian elections is a massive exercise. More than 900 million people are expected to be registered to vote this year. And unlike other countries, the voting takes over, several weeks. It happens over phases. And it is because of the size and stock of the elections, a full panel is pretty much required. So the panel now having just one member is not an ideal situation for the country when we are expecting the poll dates to be announced within the next few days and for the elections to take place in April and May.
As you said, the commission only has one member remaining, and there are allegations of a lack of transparency. Could you explain how the situation has arisen so close to the election?
Yeah, so the Election Commission has not officially commented on what has gone down. They have not given a statement on why the resignation happened. It was just announced that the resignation has taken place. And that has kind of led to allegations from opposition parties that there is a problem and this is not an ideal situation, and that there are allegations now of a lack of transparency. Though the leader of the opposition party, who is on the panel that elects a commissioner, commissioners has confirmed that they are meeting later this week. So there is a possibility that we will have more information on this over the next few days.
So what are you looking out for? What kind of information might we get, Swati?
So the panel can operate with just one member. The elections can take place, but because of the size and scope of what the elections are like, you would prefer that the entire panel is in place. And so we are expecting to possibly hear that 2 more commissioners have been appointed. So we're just waiting for the Election Commission to maybe make a statement over the next few days.
Swati, thank you so much for that. Our South Asia government reporter, Swati Gupta, joining us from New Delhi. India's been trading for about 2 minutes now. Let's do a check on how Indian markets are trading. Of course, we've seen foreign funds piling into India, in particular in recent weeks, in small and mid-cap stocks as well. Not surprising, Sensex pretty much unchanged. On a day that the MSCI Asia-Pac index is in negative territory now, tilting towards the negative side as well. In terms of Nifty, bank index currently down by 0.2%. We're keeping an eye on Indigo, by the way. The stock there is Interglobe Aviation, currently slumping about 1%. This is on the back of Indigo founder Rakesh Gangwal eyeing in an almost $800 million in block sale. It is said to be India's largest since 2009, and that's according to Bloomberg data. Indigo shares have been trading near the highest price on record, but today those stocks are down about 0.9%. Of course, we're also keeping an eye on the Indian rupee, trading close to that 6-month high versus the USD. Plenty more ahead. Keep it here with us. This is Bloomberg. It's about Tay-Tay. Singapore's economy seen getting a boost from Taylor Swift's only stop in Southeast Asia. DBS says the hospitality, food and beverage and retail sectors likely benefited from a 6-day Eros tour concert. The latest Bloomberg survey of economists shows the city-state's economy growing 2.9% in the 3 months to March. That would be the quickest pace in 6 quarters. For the year, the print expected to reach 2.5% on year, the upper end of the. And Fung there, he joins me here in the Lion City. Can talk to us about the industries which will likely benefit from Tay-Tay being here in Singapore.
Hi, Haslinda. Thank you very much for having me here today. Yep, I think there are a few industries could benefit from this, starting with the tourism industries, with the hotel segment as well as the aviation sector. And we also have more shoppers coming in that will benefit the retail sector with your shops and also your F&B players. Other than that, we think that those that offers entertainment and attractions, such as our 2 integrated resorts here in Singapore, could also stand to benefit from the flock of tourists coming in for Tay-Tay's concert here.
In terms of tourism, delve deeper into that. I mean, what are we looking at in terms of RevPAR? What are the numbers, because a lot of people are number crunching when it comes to the impact she's had on the various sectors.
Yep, certainly. So in terms of the hotel industry RevPAR, we think that this could grow by 8 to 15% this year. This is versus a 19% growth last year that we have seen. And this is amid a growth in terms of visitor numbers coming into Singapore this year. We are thinking that it could grow by around 10 to 18% in terms of the visitor numbers coming in. And this is on the high end of the Singapore Tourism Board's forecast of a 15 to 16.
Right, okay. Ken, we have to leave it there. Ken Fung there with us, and I think we have a slight audio issue at this point in time. Of course, economists have been number crunching, and Singapore itself is expected to revise up its GDP forecast because of that. Now, ARK Investment's flagship innovation ETF had not held any NVIDIA shares for about a year. We asked CEO Cathy Wood whether she regrets that decision and what might change her mind about the stock.
We wrote it most of the way up, but I'll tell you what we did. And this is, as a portfolio manager, it's not one action, but what it causes in terms of another action. Last year, we sold in the flagship NVIDIA and put it into Coinbase. Coinbase, I believe, is up at least as much as NVIDIA. And it is much less well understood. The whole crypto movement, the crypto asset movement, Bitcoin as a new asset class and so forth, is not well understood or completely accepted out there. So we prefer to go where others are not traveling as much. And, as we were moving out of NVIDIA, we were saying, okay, regulators are trying to crush Coinbase here, and we were buying it on every dip. NVIDIA happened to be one of the sources for that purchase. So it's not just what we do on the sell side, it is what we do on the buy side that you have to look at. And yes, we do hold it in the more specialized funds, but we've been taking profits there as well for reasons I just described.
Yeah, and to be fair, you're right. Coinbase is up about 620% since the end of 2022. So that compares with about 530% gain in NVIDIA. Is there anything, though, Kathy, in the NVIDIA story that would make you rethink the name and want to become more aggressive on it?
Yeah, if the price came down a lot, we would. The rate of return expectations
or a split. Would a split do it? Because I know we've been
no.
Okay.
That wouldn't change. That wouldn't change anything. No, no split adjusted then the price. So if you look at our portfolios, what we're trying to capitalize on with a Palantir, for example, are the next stages of this AI revolution. What we're seeing in the GPU side of things is NVIDIA, all praise to Jensen Huang. I mean, just unbelievable company execution, vision, and so forth. And it's not over. It's going to last a long time. But there are going to be many other companies benefiting from AI. The productivity lift alone is going to be massive, the most massive productivity lift in history, we believe. And so this AI revolution is going to be broad-based and is going to benefit a lot of companies. On the GPU side, of course, we have AMD as competition, but many people do not understand that there's a lot of other surreptitious competition evolving out there.
And that was ARK Investment CEO Kathy Wood speaking to Bloomberg's Carol Massa. It is about AI, and she says lots of companies will benefit from it. In the broader market, of course, MSCI Asia Pac Index extending its loss to more than 1%. It is about the yen that is stronger right now. That is it from Bloomberg Markets Asia. Daybreak Middle East and Africa is next. Keep it here with us. This is Bloomberg.